Hello everyone. In this video, we will be seeing about bank audit, its certain practical aspects, and about also verification of advances. We will also be covering income recognition and asset classification norms, which are released latest by the RBI. And we will also see about important things which you need to cover in bank audit during practical bank audit when you do it in the bank branch. And this is for a practical purpose, and you need not refer it as exactly book version, or for exams you need not refer it, but for students going to articleship, they need practical exposure and certain things they need to know before going to bank audit practically. So this will be covering those practical aspects all together in the video. First thing is, we need to know some basics about bank. In a bank, they will have the trial balance. This is the trial balance of the bank. In one side, there will be deposits, and in the other side, we will have cash, advances. These are all, in one way or the other, these are the assets of the bank. These are the liabilities of the bank. What are the liabilities? Deposits, which they get from the public. They use the deposits to give advances to the customers. The deposits they have to repay back to the customers. For example, you open a fixed deposit in the bank for 1 lakh and the tenure is 3 months. After 3 months, the bank has to repay it. So it is a liability. And then advances. From that 1 lakh or 3 lakhs you deposit in the bank, they will give to advance to other businesses and people who are in need of loans. They will be in different forms like loans, advances, cash credit also they can give to business, overdraft facility or bills. In many ways, the banks lend the amount to customers. So these are the assets and liabilities. And in assets, it will be ranked in liquidity position. First, the most liquid cash will be the given. Second, advances. Like that, based on the liquidity position, these will be ranked. So, first we need to know the basics about what is loan, what is advance, what are the different types of security. Everything we need to know. So, we can learn about those. The first thing is deposits. There are two types of deposits. In both deposits and advances, we have two types. One is demand and the other is time. In advances also, demand loans, term loans. What is the difference between demand and time is that in demand deposits or demand loans, you have to pay when demanded. The bank will demand payment from you. At that time, you have to pay the amount. There is no fixed tenure or like that. But the general thing is, it should be less than 36 months. Demand loans should be less than 36 months. It should be repayable within 36 months. Within 36 months, the bank will come and ask the amount. You should pay back the demand loan. This is the thing for demand loan. And for term loan, there will be a fixed tenure. How much time you have to pay the loan back, that it will be a fixed tenure. The bank will tell it to you when you are availing the loan itself. The term loans will be ranging from 3 years or more. If it is less than 3 years, it will be a demand loan. For 3 to any number of years, maximum 10 years or something it will come. For home loans and all, 15 to 20 years will also be sanctioned. So this is the demand loan and this is the term loan. So in demand deposit and time deposit also, you are depositing amount with the bank. If there is no fixed tenure and you need to, you can get the amount whenever you can demand from the bank, that is a demand deposit. For time deposit, if there will be a certain time. If you deposit the amount, after that certain amount of time only you can get the amount back. Before that you cannot withdraw the amount. This is the time deposit. Basically, demand deposit is whenever demanded you have to repay the amount or you will be getting back the amount. In term loans or term deposits, there will be fixed tenure. And then there are different types of advances like domestic and international. Domestic means within the India for business purposes and all, but international it will be specifically related to imports and exports. For importing the goods, exporting the goods, we need a certain loan facility. Not everyone will have all the amount to make a make an export transaction. So we need facilities for borrowing from the bank. For that, there are three types of things: packing credit, pre and post shipment credit, bills. These are the facilities granted by the bank related to imports and exports for the borrowers. Packing credit means when someone is exporting goods, they need to pack the goods, manufacture it, or they have to make it in a condition which will be able to sell it in the market. They have to do that and then they have to export it to outside India. Whichever country it is, they have to export it then. For that, they need a finance. They need amount, they need to borrow. For that, the bank is giving the amount. Then pre and post shipment credit. In exports, what will happen is shipment. The exporter will make certain goods and he will make the shipment of the goods to the outside country. There is two types of things, pre-shipment and then post-shipment. Before sending the goods outside to India, it is called as pre-shipment. After sending the goods outside India, it is called as post-shipment. Before sending the goods, what and all the activities which need to be done? First, you have to procure the raw material, then you have to manufacture the goods, then you have to test the goods, then you have to pack the goods. These are all the activities happening before you are sending the goods outside India. These are all covered under pre-shipment. For these activities, if you want loan, you can go to bank and you can ask pre-shipment credit. And after sending the goods outside India, the buyer has promised you payment, he will make the payment only after some certain number of days. Now you do not have the money. So now you need the money, for that you are going to loan, then it is called as post-shipment credit. If you get some pre-shipment credit loan for manufacturing the goods, for example, you are getting 1 lakh rupees, and if you get this amount and the buyer has promised payment after some 3 months or like that, then you can change the loan from pre-shipment to post-shipment. Before sending the goods, you have bought the loan, you have manufactured the goods and sent it to outside India, and now the buyer will pay only after some 3 months. Now before that you have to transfer the loan from pre-shipment to post-shipment, because the goods have been sent out. Now it cannot be a pre-shipment credit. You have to transfer it to post-shipment credit. This is basically the concept of international advances. It will be related to imports and exports. And then there are one more type of advances called clean advances. Generally for advances, they will ask security from the bank. Security from the bank side. You need to give certain land documents or whatever the item you are purchasing, you have to keep it as a pledge or mortgage, like that you have to do. There should be some kind of security. Only then they will give the loan. So first what you have to know is the loans are given based on two things. First thing what they will check is repayment capacity. What is your salary in case you are a salaried employee, or if you run a business, what is the turnover, what are the financial statements, what is the profit after tax, like that and all they will check. And then after the repayment capacity, the second thing they will see is security. These are the two main things that they see when sanctioning any loan to any customer. First is repayment capacity, second is the security. The security is very important for a loan. Only based on the value of security they will give you the loan. If you give a security worth 1 lakh, they will not give you anything more than 1 lakh as a loan. They will reduce some margin, like they will have 10% or 20% margin. That much they will reduce, and only remaining 90,000 they will give you as a loan. This is the standard procedure. But there are some advances called clean advances. For that, no security is required. The banks will straight away give the loan without any security. It will be based on the repayment capacity only. They will not ask any security. That is an example. The classic example is personal loan. When you get a personal loan from bank, they will not ask any security. They will see your salary or a pay sheet, and as per that, they will give up to 5x of your salary. That much they will give you a personal loan. Since there is no security, the banks can charge a high amount of interest on those loans. The rate of interest will be 16% maximum. Like that much percentage they will charge on loans without security. If you have a security, the rate of interest will be less. But if you do not have any security, the rate of interest will be generally very high. You can very easily understand why the logic is like this. If you have a security, there is a certainty. You have a guarantee. Even if the borrower does not pay back, you can sell the security and recover the amount. But if you do not have any security, if the borrower fails to make repayment, you cannot have any repayment resources. You cannot have any recovery options. So for that there is a risk factor which is higher in the non-security loan. So for that the rate of interest is generally high. So for clean advance personal loan, the rate of interest is high. And then cash credit and overdraft. These are mainly used by businesses for working capital loans and short-term liquidity positions. For that they are using these both facilities. For this you need to have a current account for availing cash credit. Under businesses they will have a current account and they can get cash credit from banks. This cash credit is primarily got for working capital purposes. For short-term financing they will use this. They will not get any long-term loan by using cash credit. What is working capital purposes? For current assets like cash, inventory, you have to buy inventory, or your amount is locked up on receivables. People have borrowed on credit from you and they are not giving, that current liability is there. Like that, certain for working capital purposes, you can get the amount from bank. This is given based on financial statements and GST. And here the important thing is there is primary security. There will be security. Without security, they will not give you cash credit. The security here is current assets. What are the current assets? Generally, businesses will have stock as their current assets and they will have debtors as their current assets. What is stock? The item which you sell in the business is the stock. That value they will take it based on the stock statements. Every 3 months you have to submit stock statements to the bank and based on that they will give you the loan. And debtors, people who have bought goods on credit from the business but they are not paying back, they will be paying back on a later day or after a certain period of time. These are called as debtors. Based on this also you can get loan from the cash credit. So the loans for working capital, it is based on security. These are the securities. For the cash credit, there are two types of things. First thing is sanctioned limit. And then one more thing is drawing power. What are these two things? If you go for a cash credit loan, they will see your repayment capacity, your turnover and everything they will see, and by seeing this, they will take the sanction limit. They will allow the sanction limit. For example, they are allowing 5 lakh as sanction limit to you. But this is just the sanction limit. How much amount you can withdraw from that loan, that is decided based on the drawing power. How the drawing power is decided? Sanction limit is 5 lakh based on repayment capacity. Drawing power, how they are calculating? For that only they are asking the stock statements. If you give the stock statement, what they will do is they will make valuation. How much stock is there? Based on this, how much loan we can give? Like that they will see. After seeing the stock statement, they will decide drawing power. Like 3 lakhs is your drawing power. Like that they will give. Once the drawing power is given, you can withdraw up to 3 lakh. The sanction limit is 5 lakh, but you can draw only up to 3 lakh because the stock statement you gave, there is only 3 lakh worth of stock in there. If you do not pay the 3 lakh, the bank can recover the amount by selling the stock. For extra 2 lakhs, they do not have any security. So they are not giving that extra 2 lakhs. Sanction limit based on repayment capacity. Drawing power is based on the stock statement or debtor statement, how much current assets you have at any point of time. Based on that, they are deciding the drawing power. Next, overdraft. Bank overdraft is a common facility. What they are doing is that if you have balance, for example, 1 lakh in your account, current account, you are having 1 lakh balance, but they are giving a facility that you can withdraw up to 1 lakh 30,000. You can withdraw 1 lakh and along with that you can withdraw extra 30,000. This 30,000 will come as a negative balance in your account. This is like overdraft. You can overdraw from the account more than the balance which you have. This will be considered as some kind of loan. This the businesses are getting for liquidity purposes. Suddenly some amount is not there. We have it as inventory, but we do not have it as cash immediately. So in this case, we can get overdraft and make the liquidity position all right. So for this purpose, we are getting overdraft. And one more thing, loan against deposit is also a common loan given by banks. You are opening fixed deposit in banks. For that deposit also, you can get loan against them. For example, you are opening 1 lakh fixed deposit for rupees 1 lakh and the tenure is 3 months. Now you need suddenly loan of 50,000. Now what you can do is, you can keep this fixed deposit as security. And by pledging this deposit, you can get the 50,000 loan. The interest rate for fixed deposit is, for example, you can keep it as 7%. Now what will be the rate of interest for the loan against this deposit? It will be generally 2% more than the deposit rate. If the deposit is at 7%, you should add 2% and then the loan rate of interest will be 9%. This is how they arrive at the deposit interest rate, the rate of interest for loan against deposit. For how much tenure they can give this 50,000 loan, the tenure, how much time they have to repay this loan. This will be decided based on the tenure of the deposit. If the original deposit is for 3 months, then the loan also, the maximum tenure will be 3 months. You cannot give 4 months for loan against a deposit because the original deposit itself will mature in 3 months. This is the concept of loan against a deposit. Now we saw security. The bank will be seeing security while sanctioning any loan. That security, there are two types of loans, fully secured and partially secured. For example, if the loan amount is 1 lakh, but you have security for only 50,000. Remaining 50,000, there is no security. Now, this loan is a partly secured loan. The full amount is 1 lakh, but only one part, 50,000, is secured. Remaining part is unsecured. So, this is a partly secured loan. But if you have the security for full 1 lakhs, it will be a fully secured loan. For this security also, this value, how they are determining is, they will keep an independent valuer. For independent immovable property and all, they will keep an independent valuer, and at the time of sanctioning the loan, they will make a valuation of the property. And after that also, every 3 years, they will make valuation of the immovable property. That is how they come to know about the value of the security. So, if we can take that, if the time of initial valuation, at the time of sanctioning the loan, the value is 3 lakhs. The loan amount is also 3 lakhs. So now this is a fully secured loan. But after 1 year, you are making another valuation of the same immovable property. Now the value is coming as 1,50,000. Now also the loan amount is 3 lakh only. Earlier it was a fully secured loan. But now, because the value of security has come down, it has become a partly secured loan. This is only written here. If the value of security diminishes, the fully secured loan becomes partly secured. This is the concept of partly secured loans. And generally, fully secured loans, we can take example of jewel loans. They will keep jewels as pledge, and the customers will get loans. For that loan, there will be security. The jewel itself is the security. If the borrower does not pay, we can sell the jewel and take the amount. And security should be tangible property. You cannot give any rights or any license as security and get a loan. You should not get loan by giving rights or license as pledge. You should give any tangible property. Like in cash credit, we gave current assets, stock, that and all we gave. And then in immovable property also we gave as security. Like that, it should be some tangible property. And if you have an advance, and it will guaranteed by central government. If it is guaranteed by government, then will it come under secured? That is the question. Now, in that they have three categories in the balance sheet of the banks. First thing is secured, second thing is covered by bank or government guarantee, third thing is unsecured. Like if it is guaranteed by government, it will not come under secured. There is a separate category for guaranteed by government. The loan which is covered by government guarantee. Under that category it will come. It will not come under secured. And the next thing we are going to see is about security, types of security. There are two types of security. One is the primary security, and the second one is the collateral security. You may have heard in many places that banks ask for collateral security. We do not have any collateral security like that. You may have seen in movies or web series or certain things, when people go for loan from bank, they will ask for collateral security. But we do not know what is collateral security. We will think that just it is a security. Now we are going to see in detail what is collateral security. First thing is primary security. It is the main security for any loan. For example, you are taking a loan for purchasing a car. It is a car loan. In this, the primary security is the car itself. The car you are hypothecating, and then only you are getting the loan. That is the primary security. If you do not pay back, the first thing they will take is car. By taking the car, they will sell it and recover the amount. So, this is the item purchased out of the loan proceeds. You are getting loan. By that loan amount, what are you doing? You are purchasing car, or you are purchasing land, or you are purchasing home in case of housing loan. For that main item purchased, that will be the primary security. And then collateral security. It will be out of the scope of the loan. It will the security provided as collateral will not be related to the main transaction, but it will be provided as a security. For example, you are taking a car loan, but you are giving as collateral security land documents. Land is nowhere connected to car, but still you are giving it as a security. This is out of scope of the loan. Land is not related to car, but you are giving it as a security for the bank. If the borrower does not repay, in this case, first what they will do, they will take the car. And after taking the car, if the amount cannot be recovered by selling the car, some amount is remaining, for that they will sell the land and they will recover the amount from the land. First thing, they will go to the primary security. Second, they will touch the collateral security. In some cases, without primary security also, only based on collateral security, they can give the credit. Now, these are the basic things which we need to know about the bank audit, about deposits, cash, advances, demand deposit, time deposit, in loans also demand and time, related to export-import deposit, and then clean advance, cash credit, bank overdraft, loan against deposit, security, and then the types of security, everything we saw.